Warren Buffett is the name that comes to mind when we talk about the greatest investor of all time. His name is practically synonymous with the title. Back in 1956, Buffett began managing $105,000 for family and friends. Today, that has compounded into over $500 billion. Astonishing. But what about the second greatest investor who claims that spot? Let me introduce you to Anthony Boulton. Boulton is not a household name like Buffett, but in the author's opinion, he stands firmly in second place on the all-time investments greats podium. This legendary fund manager from the United Kingdom helmed the Fidelity Special Situations Fund from 1979 to 2007, achieving an annualized return of 19.5%. To put that into perspective, the market yielded just 13.5% during the same period. Had you invested £1,000 with Boulton back in 1979, it would have grown to a staggering £147,000 by the time he stepped down. If stellar needs a dictionary definition, this would be it. But even legends stumble. In 2010, Boulton came out of retirement to launch a new £460 million fund. His reputation and track record brought in investors in droves. Yet, over the next 3 years, this fund lost 14%. By 2014, Boulton stepped away, leaving behind an underwhelming legacy for this venture. The question is why? How could a man who consistently outperformed the market for nearly 3 decades face such a dramatic failure? Was it bad luck? A misstep? Or was there something deeper at play? This is The Better Investor, summarizing the best investment classics for you, and this is the second part from the top 5 lessons from the book, What I Learned About Investing from Darwin, written by Pulak Prasad. Lesson number 1. The dishonest signaling. Before we uncover the mystery of Anthony Boulton, let's take a broader look at deception. Humans pride themselves on their intelligence, but we often deceive, sometimes for power, sometimes for prestige. Think about bodybuilders and fitness influencers. Many claim their physiques are a result of hard work and clean eating, but in reality, steroids often play a massive role. They project an image of perfection only for many to face severe health issues, strokes, or cardiac arrests later on. Or take the world of social media. How often do we see these influencers flaunting rented Lambos, Ferraris, or luxury mansions, signaling wealth and success that doesn't exist? And let's not forget big corporations. They slap labels like high protein or healthy on cereal boxes. But when you read the fine print, it's just sugar with a sprinkling of marketing genius. Deception isn't confined to humans either. It's everywhere in nature. It's rampant. Take the male green frog. These frogs croak in low frequencies to signal strength and dominance to females and rivals. But smaller, weaker frogs, they mimic these croaks to appear more dominant than they truly are, just so they could mate with beautiful female frogs. Or the fiddler crabs. Males grow oversized claws to attract females and intimidate rivals. But some claws, they're all show, large, weak and prone to breaking in actual fights. Even orchids deceive, mimicking the scent of female wasps to lure male for pollination. In nature, just as in human society, dishonest signaling is rampant. Now let's tie this back to investing. Companies, like people and animals, often engage in dishonest signaling. They craft press releases, management interviews, and earnings report to dazzle investors. But the reality behind these polished narratives can be starkly different. Take Wirecard. In 2019, it was a 18 billion euros financial giant. Its CEO, Marcus Braun, exuded confidence, dismissing any accounting concerns. Analysts overwhelmingly recommended a buy. Fast forward a year, fraud allegations surfaced, Braun was arrested, and Wirecard collapsed. Investors who relied solely on corporate signals were left blindsided. So how do we protect ourselves from such deception? If a company claims to be a tech leader, look at their R&D spend and innovation and not just their PowerPoint presentations. If a chemical company says that they are a specialty chemical company, validate it through their operating margins. And if a company boasts of being a monopoly supplier, scrutinize their working capital cycle. Dominance should reflect efficiency. Press releases may dazzle, but as the author puts it, they're often cheap signals. Cheap signals meant to attract investors, competitors, and customers. Real insights lie in hard data and industry expertise. Now let's return to Bolton. I deliberately held back a crucial piece of the story earlier. Bolton's fund wasn't launched in the United Kingdom. It was launched in China. China is not the United Kingdom, especially when it comes to corporate behavior and corporate governance. Many Chinese companies have faced allegations of fraud and accounting irregularities. Bolton's top 3 holdings in this fund weren't exceptions. They suffered from financial scandals and product frauds. He took the disclosures by the companies and their guidance at face value and underestimated the risk of operating in a fundamentally different market, where signals were far less reliable than those he was accustomed to in the UK. The lesson here is clear. Whether in nature, the corporate world, or life itself, not all signals can be trusted, and even the greatest investors like Anthony Bolton can fall prey to deceptive signals if they don't adapt to their environment. Lesson number 2. Grant-Kurtén's principle of investing. According to a Morgan Stanley report from 2018, the average holding period for mutual funds has dropped dramatically from 7 years in 1960 to less than 1 year in 2018. This isn't happening in isolation. Fund managers are reacting to something. Often the latest news splashed across prestigious financial outlets. But what if this obsession with short-term news is the very thing sabotaging long-term gains? Let's try a thought experiment. Imagine it's January 2009, during the peak of global financial crisis, and you have some money in your pocket. You decide to invest in L'Oreal, the world's largest cosmetics company, paying 60 euros per share. Your reasoning? A high-quality business like L'Oreal can weather short-term storms. But over the years, headlines emerge. L'Oreal loses a legal battle to eBay for counterfeit products. A Danish watchdog declares one of its products harmful. The chairperson is embroiled in a messy legal dispute. Fast forward to 2011, things look even grimmer. Fines for price fixing, banned advertisements, and profit margins taking a hit. Even Owen Jones, the company's legendary leader, resigns abruptly. In the face of all this, would you have held on? Most wouldn't. But let's pause here and introduce an intriguing idea from the evolutionary biology, the Grant-Kurtén's principle. It shows how changes appear exaggerated over short periods but stabilize over the long term. Applied to investing, this means ignoring short-term noise when you own exceptional businesses. This is the Grant-Kurtén's principle of investing. The principle is simple. Focus on businesses that don't fundamentally alter their character over time and treat short-term fluctuations as opportunities to buy and not reasons to sell. Now let's revisit L'Oreal. Between 2009 and 2021, despite the noise, its core remained rock solid. Sales grew from 17.5 billion euros to 28 billion euros, and the company stayed true to its roots. No wild acquisitions, no distractions, just steady leadership in global beauty markets. If you had ignored the headlines, held on, and maybe even bought more during dips, your investment at 60 euros per share would now be worth 329 euros, a 450% gain. The takeaway? Don't let the news derail your long term conviction. But wait, what about companies like Nokia or Kodak? Wouldn't GKPI have failed there? Absolutely. No model is foolproof. The author of this principle, who runs Nalanda Capital, acknowledges this. GKPI isn't perfect, but it works well most of the time, especially with a portfolio of high quality businesses. The real art lies in knowing when to sell. Well, that brings us to the next lesson. Lesson number 3. When should you sell a business? If the Grant-Kurtén's principle of investing urges us not to sell, then why do we sell at all? The author explains it simply. Not on valuation. Selling just because a stock appears expensive is a common trap. Instead, the portfolio operates without any target price for selling. So when should you sell? There are only 3 valid reasons, the author states. First, a decline in governance standards. Second, egregiously wrong capital allocation. And third, irreparable damage to the business. Since 2007, Nalanda Capital, Pulak Prasad's fund, has sold 9 businesses, averaging just 1 exit every 1.5 to 2 years. 6 of these exits happened because the businesses was deemed beyond repair. Here's an example. Nalanda invested in a leading player in an oligopolistic industry, a textbook high quality business. For the first couple of years, everything was smooth. But in year 3, the company began losing market share. 2 quarters in a row. Worse, its losses in a smaller but highly profitable segment started accelerating. Rather than reacting immediately, the author gave the company 3 years to turn things around. But when it became clear the competitive edge was gone, Nalanda exited. They weren't interested in owning a business consistently falling behind its competition. During those 3 years, there was no shortage of news, both good and bad, about the company. But the author didn't get swayed. The focus stayed on one thing: market share trends. This approach stems from a fundamental truth. No business grows in a straight line. Even the best performing companies in Nalanda's portfolio have had wild swings when measured over weeks or quarters. The default option? Ignore short-term noise and focus on long-term. But here's your next question. How long is long-term? And since new businesses keep destroying old ones, won't we be left with only failed businesses after a few decades if we keep holding on? And what about businesses being disrupted? Won't holding on forever leave us with failures like Kodak or Nokia? Well, that brings us to the next lesson. Lesson number 4. How long is long term? At the end of the last lesson, we were left with 2 big questions. How long is long term? And since new businesses often replace old ones, won't we end up holding on to failed businesses over time? Let's dive into this. In October 2015, the American Enterprise Institute published a striking headline: Fortune 500 firms in 1955 versus 2015. Less than 15% remain, thanks to the creative destruction that fuels economic prosperity. The article highlighted the 61 US companies that had survived on the Fortune 500 list for 60 years. At first glance, this sounds like a warning about the rapid pace of capitalism and creative destruction. But if you take a look closer, the story changes. In reality, 72 companies, about 14%, had stayed on the list for 6 decades. Think about how turbulent those 60 years were. We are talking about the rise and fall of the Cold War, the advent of the space age, the US civil rights movement, oil shocks, financial crisis, and the global dominance of tech firms, and the exponential growth of mobile phones and digital transformation. Despite all that, businesses like 3M, Colgate-Palmolive, Caterpillar, Kellogg's, Pepsi, and Pfizer didn't just survive, they thrived. But there's more. If we add companies that were acquired by other Fortune 500 giants of 2015, like Gillette acquired by P&G, Wrigley acquired by Mars, Quaker Oats acquired by PepsiCo, and many others, the picture becomes clearer. Another 73 companies, that is around 15%, remained successful, albeit under new ownership. Even more surprising, about 60 to 75 businesses continued performing well even after falling off the Fortune 500 list. When we total it up, roughly 40 to 45% of the 1955 Fortune 500 list consisted of high quality businesses that performed exceptionally over last 60 years. That's not a small number. So what does this tell us? Long term is truly long term. We're talking about 5 decades or more. And second, yes, new businesses replace old ones, but the pace of change is slower than we think. High quality businesses are far more resilient than most investors assume. Despite all the shocks and disruptions, these companies have proven their ability to adapt and thrive over the long run. Sure, the Kodaks and the Nokias of the world would fall into the 60% of the businesses that failed, but the magic is done by the remaining 40%. So why sell it all? That brings us to the next lesson. Lesson number 5. Understanding compounding. October 1988. Forbes releases its iconic list of America's 400 wealthiest. Sam Walton tops it with a $6.7 billion fortune. Buffett ranks 10th with $2.2 billion. Familiar names like Gates, Packard, Mars, and Redstone fill the ranks. Then, at number 197, a name no one recognizes. Shelby Cullum Davis. Who was he? He wasn't a tech visionary. He didn't start a retail empire. He wasn't even an investment banker as Forbes claimed. Yet, Davis had quietly amassed $370 million. He had slipped past the world's greatest entrepreneurs onto the same stage without anyone noticing. Here's what's truly fascinating. He didn't start investing until age 38. His background was in history, not in finance or business. He wasn't managing other people's money. It was all of his own, well, technically his wife's. So how did this unassuming historian create one of the greatest fortunes in America? The answer lies in understanding something almost magical. But to grasp it fully, let's go back to Australia of the 1850s. Imagine the year is 1859. Thomas Austin, a wealthy farmer in Winchelsea, has a peculiar idea: importing 24 rabbits from England for hunting sport. And he consults you, his trusted advisor. Before you can speak, a man storms in, a time traveler from 1925, and he says, "Don't release those rabbits." The man pleads, "I am from the future and I have seen what happens. Australia will be overrun, entire farms destroyed, and wildlife decimated." Austin smirks. "Overrun? With 24 rabbits?" You say, "That's absurd." The man insists, "You won't notice it at first. The rabbits will grow at 35% a year. At this rate, by 1925, there will be 10 billion rabbits." You and Austin laugh. After all, 24 rabbits in a continent as vast as Australia, what could possibly go wrong? You dismiss the time traveler's warning, and Austin releases the rabbits after consulting you. Fast forward 35 years. The time traveler returns, panicked, and he says, "Kill the rabbits now before it's too late." You shrug. Too late? That's fewer than 1 million rabbits on 8 million square kilometers of land. See, nothing has happened and you were wrong. "Please," the man begs. "Their numbers are still compounding. The danger hasn't hit yet. It's coming. Trust me." You ignore him again and you say, "Where are the rabbits?" Another 30 years pass. By 1925, the traveler's prediction has come true. 10 billion rabbits now ravage Australia's farmland. Crops are wiped out, native species are dying, the government tries everything, fences, hunting, even releasing a deadly virus. Nothing works, the rabbits have taken over. The story of Australia's rabbit plague is true, and it illustrates the two most misunderstood truths about compounding. First, it creates astronomical numbers over time. Few can imagine 24 rabbits turning into 10 billion at 35% compounded rate. And second, it starts slow. For decades, the rabbits seemed harmless until suddenly they weren't. And this brings us back to Shelby Cullum Davis. In 1947, Davis left his job at age 38, armed with $50,000 borrowed from his wife, Catherine. He began investing. His focus? Dividend-paying insurance companies selling below their book value. At first, no one noticed. Most of his picks were unremarkable. Many failed. He even made some terrible mistakes like sinking millions into junk bonds that lived up to their name, junk. But Davis had a superpower. He never sold his winners. Over the next 45 years, he held on to a handful of quality businesses. By 1992, 2 years before his death, Davis's fortune had grown to $900 million. Half of it came from just 12 insurance companies he'd bought decades earlier. For example, AIG, his top holding, was worth $72 million. Berkshire Hathaway, another standout, grew to $27 million. Despite his failures, most of his 1,500 global investments flopped. The winners grew so large they dwarfed the loser. Consider Nalanda Capital, the fund run by author Pulak Prasad that invested $18 billion across 17 companies from the time period of 2007 to 2011. By 2022, here's what happened. 7 of the 17 companies failed. By fail, I mean they failed to generate even return of 10% compounded annually, though even one of them had a capital loss. But one investment, Supreme Industries, turned $1 billion into $14 billion. Enough to cover all the losses and then some. Here's the kicker. A single standout investment, Page Industries, outperformed the failure of 7 companies by 5x. Shelby Cullum Davis and Warren Buffett had little in common, except one thing: they both understood the magic of compounding and the value of time. Davis didn't have to win every time, he didn't even have to win often. He just had to let his winners run long enough to outgrow everything else. So why don't more investors follow this approach? Because compounding doesn't work fast enough to satisfy human impatience. The truth is, wealth, like rabbits, starts slow. It's invisible at first, but with enough time, it becomes unstoppable. If you want to build extraordinary wealth, learn from Shelby Cullum Davis and of course, the rabbits. Pick quality, be patient, and never underestimate the power of compounding. Let's have a quick recap. Company craft press releases, management interviews, and earning reports to dazzle investors, but the reality behind these polished narratives can be starkly different, so take these with a pinch of salt and look deeply. Avoid reacting to daily news, be it good or bad, and lead yourself to some activity. Ignore the short-term news and fluctuations and focus on the long-term trajectory. Give time to businesses when they hit a rough patch, as no businesses grow in a straight line. There are only 3 valid reasons to sell: a decline in governance standards, egregiously wrong capital allocation, and irreparable damage to the business. High-quality businesses are far more resilient than most investors assume, and though new businesses replace old ones, the pace is slow. A portfolio approach takes care of the failed businesses. Compounding has the power to transform a small number to a very large one, and the effects of compounding are small and easy to ignore initially until they aren't. That's it, guys. If you liked the video, please like, share, or subscribe. I will come again soon with a summary of another investing book. Until then, cheers, guys.